In June 2020, one of Germany's most celebrated companies announced that 1.9 billion euros it claimed to have in trust accounts around the world simply did not exist. Not lost, not misplaced, never there. Within 72 hours, the stock collapsed 85%. The chief executive was arrested, the chief operating officer vanished from the face of the earth. The company that had been worth 24 billion euros, more than Deutsche Bank, filed for insolvency. It was the largest accounting fraud in European history, and it happened inside a company that Angela Merkel personally championed, that German regulators protected, and that EY signed off on for 10 consecutive years. This is the story of Wirecard, the German fintech that fooled the entire world. And the 3 lessons every business needs to understand about trust, brand credibility, and what happens when an entire country desperately wants to believe a lie. Quick pause. If you find stories like this fascinating, brand collapses, corporate frauds, the business decisions that changed history, this channel covers one every week. Hit subscribe. It takes 2 seconds. Now back to Wirecard. Wirecard was founded in 1999 in Munich at the height of the dot-com boom as a payment processor for online merchants. In the early days, it was nothing special, a small company helping websites accept credit card payments with a particular focus on industries that traditional banks refused to touch. Online gambling, adult content, the gray zones of the early internet. But in 2002, something changed. A consultant from KPMG named Markus Braun was brought in to help stabilize the business. He never left. Braun took over as chief executive and immediately saw something others had missed. The digital payments revolution was coming, and whoever built the infrastructure for it first would own the future. Braun modeled himself on Steve Jobs. He wore black turtlenecks. He talked about changing the world. He had a doctorate in social and economic sciences and spoke about technology with a conviction that made investors feel they were watching history being made. Under Braun, Wirecard grew rapidly. The company pivoted away from gambling, expanded into legitimate payment processing, and began acquiring companies across Asia and the Middle East. By 2015, 3 partner firms in Dubai, Singapore, and Manila were reportedly generating more than €500 million in annual revenue. By 2018, Wirecard was processing €125 billion in transactions per year and generating revenues of €2.3 billion. Its shares hit an all-time high of €191 in September 2018. That same month, Wirecard replaced Commerzbank in Germany's DAX 30 index. It had become one of the 30 most valuable and most important companies in the country. It was worth more than Deutsche Bank. German Chancellor Angela Merkel personally raised Wirecard's acquisition of a Beijing-based payments company in a meeting with Chinese President Xi Jinping. Germany had found its tech champion, its answer to PayPal, its proof that European companies could compete with Silicon Valley. There was just one problem. Much of it was fiction. Here is what was actually happening inside Wirecard while Germany celebrated its new tech giant. The 3 partner companies in Dubai, Singapore, and Manila that were supposedly generating all that revenue were largely fictitious. The cash they were supposedly holding on Wirecard's behalf did not exist. The 1.9 billion euros that sat on Wirecard's balance sheet, representing roughly a quarter of its total assets, had never been there. Wirecard's business model was deliberately designed to be impossible to understand from the outside. The company's financials consistently lacked the detail needed to verify its claims. The third-party acquirer structure, outsourcing payment processing to those 3 companies in Asia and the Middle East, created a layer of complexity that obscured everything. And when journalists started asking questions, Wirecard did not answer them. It attacked them. The Financial Times had been investigating Wirecard since at least 2015. In January 2019, it published a detailed report based on thousands of internal emails provided by a whistleblower, alleging that employees in Wirecard's Singapore office had been involved in fraudulent accounting. The evidence was substantial and specific. Wirecard's response was not transparency, it was war. The company's lawyers filed criminal complaints against the Financial Times journalists. Braun and his chief operating officer, Jan Marsalek, told investors the Financial Times reports were malicious attacks by short sellers trying to manipulate the stock price. They hired private detectives to surveil and threaten those who raised doubts. And in one of the most extraordinary moments in this story, Germany's own financial regulator, BaFin, took Wirecard's side. Instead of investigating the company, BaFin investigated the journalists. It temporarily banned short selling of Wirecard stock, effectively protecting a fraud from market scrutiny. The message sent to the market was unmistakable. Germany believed in Wirecard. Germany was protecting Wirecard. And for a while, it worked. The stock recovered. Investors who had been skeptical came back. EY continued to sign off on the accounts. The fraud continued for years. But here's where the story stops being about money and starts being about power. Then came 2020, and the walls closed in. In April 2020, KPMG completed an independent review of Wirecard's accounts that Wirecard itself had commissioned, expecting it to be an exoneration. Instead, KPMG reported that it could not verify the existence of revenues from the third-party businesses. It could not confirm whether those 1.9 billion euros existed. The report was damning in its ambiguity. Braun tried to claim it as a victory. Almost nobody believed him. On June 5, 2020, police raided Wirecard's headquarters in Munich. On June 17th, EY, after 10 years of signing off on Wirecard's accounts, refused to sign the 2019 annual financial report. They could not locate the money. On June 22nd, Wirecard issued a statement that shook Germany's financial world. The 1.9 billion euros in cash that was supposed to be held in trust accounts in the Philippines, the statement said, with overwhelming probability does not exist. The stock fell from 100 euros to 15 euros in a single day. Markus Braun resigned that evening. By June 25th, Wirecard filed for insolvency. It was the first member of Germany's blue-chip DAX index ever to do so. 6,000 employees lost their jobs overnight. And Jan Marsalek, the chief operating officer who had built the third-party structure at the heart of the fraud, simply disappeared. What followed reads like a spy novel, because it is. To understand Jan Marsalek, you have to understand that he was never just a fintech executive. He seemed to exist in multiple worlds simultaneously, worlds that had no business touching each other. He was born in Vienna in 1980. He never completed a university degree. He joined Wirecard as a teenager, essentially teaching himself technology, and rose to chief operating officer by his late 20s. Those who knew him described a man with extraordinary charm and almost no empathy. A sales genius, one former friend said, a catcher of people. He spoke multiple languages, he flew in private jets, he hosted champagne parties on the French Riviera, and he maintained an office in Munich directly opposite the Russian consulate, where he regularly entertained intelligence officials, politicians, and figures from the world of private military contracting. The moment that changed everything came on July 6, 2014. Marsalek was on a luxury yacht off the south of France for a birthday party. A Russian model named Natalia Zlobina, who investigators later concluded had been specifically assigned to recruit him, introduced him to a man named Stanislav Petlinsky. Petlinsky described himself as a security consultant. In reality, he was a commander of a GRU Special Forces unit who had previously served in Chechnya. By the end of that evening, according to investigations by Der Spiegel, The Insider, and PBS Frontline, Jan Marsalek had begun his second life as an agent of Russian military intelligence. What he did next defies belief. In 2017, Marsalek flew from Munich to Beirut, then onward to the ancient Syrian city of Palmyra, where Russian forces and Wagner mercenaries were fighting. He posed in military gear. He discussed using body cameras worn by mercenaries to stream combat footage, what he apparently described as a human safari. He met with the head of Wagner's Secret Service, a former GRU officer who arrived on a private jet from Moscow. He then turned his attention to Libya. He proposed training 15 to 20,000 Libyan militiamen to control the country's southern border and manage refugee flows into Europe. The invoice for this operation was to be sent to the Russian-Libyan Cultural Institute in Moscow. He invested in cement factories that would be used in Libya's reconstruction. He used funds siphoned from Wirecard to buy a private mercenary company deployed in crisis zones. He compiled databases of Wirecard customer data from German federal agencies, international companies, and financial institutions, and reportedly handed it to Russian intelligence. The German intelligence service BND says it never requested the data. Interpol later concluded that Marsalek had been working for Russian intelligence for at least 10 years while simultaneously running one of Germany's most celebrated companies. When Wirecard collapsed in June 2020, the GRU did not abandon him. They had a plan already in place. Within days, former officers of Austria's own domestic intelligence agency, people Marsalek had personally recruited and kept on his private payroll, arranged a private jet. He flew from Germany to Belarus, where Russian agents met him at the border. He was taken to Moscow. He was given a new Russian passport under the identity of Konstantin Byazov, a real Orthodox priest living in the city of Lipetsk, southeast of Moscow, who happened to look like Marsalek and was born within a year of him. When journalists tracked down the real Byazov, the priest refused to speak. "I have told you that you journalists must understand that we cannot speak with you," he told a German television crew. Since then, Marsalek has lived openly in Moscow under multiple identities. In September 2025, investigators from Der Spiegel and The Insider tracked his phone signal to the area around Lubyanka Square, the fortress-like headquarters of the FSB, Russia's domestic intelligence service. The phone was detected in the vicinity of FSB headquarters 304 times in a single 4-month period. Investigators also obtained photographs of him entering and leaving the building. By 2025, he was appearing there nearly every working day. On July 1st, 2025, a PBS Frontline investigation photographed him strolling across Moscow's Trubnaya Square with his girlfriend, a Turkish language translator who also appears to work for the FSB. A pair of sunglasses dangled from his collar, her hand in his, perfectly relaxed, untouchable. He has also, according to security sources, traveled to occupied Ukrainian territory. His phone signal was tracked to a Russian border town near the front. He visited Crimea at least 5 times, accompanied by Russian special forces. One source told investigators he participated in combat operations. He posted a photograph of himself in uniform with a Z patch. Meanwhile, in December 2024, a London court convicted 6 Bulgarian agents of spying for Russia. Their ringleader, according to prosecutors, was Jan Marsalek, operating under the alias Rupert Tixi Zez. The group had been plotting to kidnap and assassinate dissidents and investigative journalists across Europe, including 2 of the journalists who later wrote about Marsalek's life in Moscow. Germany wants him. Interpol has issued a red notice. He is the most wanted white-collar criminal in European history, and he is living freely, apparently integrated into the highest levels of Russian intelligence under the direct protection of the Kremlin. Markus Braun, meanwhile, is on trial in Munich at a high-security courtroom in Stadelheim prison. The trial, which began in December 2022, is expected to run for years. Braun maintains that he too was a victim, that Marsalek deceived him. Prosecutors say he knowingly signed false accounts from at least 2015 onward. Banks lost 3.1 billion euros in loans that were never repaid. So what actually happened here? And what does it mean for anyone who runs a business, works with a brand, or trusts a company's public image? There are 3 lessons from the Wirecard collapse that apply far beyond this case. Lesson 1. Complexity is not the same as credibility. Wirecard built a business model that was deliberately difficult to understand. The third-party acquirer structure, the obscure subsidiaries in Dubai and Manila, the dense financial reporting, none of it was accidental. It was designed to make scrutiny impossible, and for years it worked, because people confused complexity with sophistication. When you cannot understand how a company makes money, that is not a sign of your ignorance. It is a warning sign about the company. Lesson 2. National pride is the most dangerous bias in business. Germany needed Wirecard to be real. After years of watching American tech companies dominate the world, Germany had found its champion. Its DAX entry was a moment of national pride. Angela Merkel raised it in meetings with Xi Jinping. BaFin banned short selling to protect it. And because the country needed the story to be true, it refused to examine whether it was. Investigators and financial historians who have analyzed this case frame it precisely. The Wirecard fraud was sustained not just by criminal behavior, but by a deep institutional desire for a German tech success story. Confirmation bias does not just affect individuals, it affects entire nations. Lesson 3. When a company attacks its critics instead of answering their questions, the critics are almost always right. Wirecard never answered the Financial Times. It sued them, surveilled them, and tried to destroy them. BaFin investigated the journalists rather than the company. And for years, this strategy worked well enough to keep the fraud alive. But the pattern is consistent across every corporate scandal in history, from Enron to Theranos to Wirecard. The moment a company weaponizes its legal team against the people asking questions is the moment the questions become more important, not less. The most astonishing thing about the Wirecard story is not that the fraud happened. It is that so many people with so much information chose not to see it. The Financial Times published its first detailed report in 2019, based on thousands of internal emails from a whistleblower. Those emails described specific fraudulent transactions, specific falsified accounts, specific individuals involved, and the response from Germany's financial establishment was to protect the company and investigate the newspaper. Wirecard was not too complex to understand. It was too important to question. And that distinction between something that cannot be understood and something that nobody wants to understand is the most expensive confusion in the history of German finance. 3 lessons from Wirecard. 1. Complexity is not credibility. 2. National pride is the most dangerous bias in business. 3. When a company attacks its critics instead of answering them, the critics are right. If this video changed how you think about corporate trust and brand credibility, drop a comment below. I want to know which moment in this story surprised you most. Was it the Russian spy? The German regulator protecting the fraud? Or the 10 years that EY signed off on accounts that did not exist? And if you want to see how Walmart spent $1 billion trying to conquer Germany and lost everything, that video is right here. Subscribe so you do not miss next week.